All right, so I got a fun one for you guys today. Today we're going to be talking about TFSA versus the RRSP. So mainly two things. What are we putting in them and what do we max first? Ideally, you want to max your registered accounts before your non-registered accounts, just for those tax purposes. And if you are, just starting out and, you're young, and you are making quite a bit and you are starting to put money away, then I congratulate you, because you might actually be able to max out both within maybe the first or second year. And the rest of you, if you're earning a very high income, you switch to a lot of savings, then you could be maxing out both. So you might not even have to worry about this, right? But for the rest of us, let's figure out what actually the difference is, what the benefits are, and what should we be putting in and maxing first. So what are the benefits to a TFSA, right? So you guys don't know, a TFSA is a tax-free savings account. So it was introduced in 2009 with a contribution room of $5,000. I put a little graphic for you guys. So if you've never contributed and you were 18 years of age as of 2009, then you have a cumulative total of $69,500. If not, you just take the year that you turned 18, and then you count from there. So, right, if you're younger, and you turned 18 a few years ago, right, you wouldn't have as much to put in accumulation, but you'd have a greater kind of going forward. You'd have a greater amount to be put in rather than the beginning. Usually, it increases by 500 or so every so years. In 2015, there was a kind of a little extra bump. I think it was during the Harper government, the transition to Trudeau. They gave to 10,000, but then it was given back because it's too much to be tax free apparently. Anyway, we won't go into that. So this is the contribution room. The TFSA is actually, as it says, it is tax-free. So this is actually mostly for US companies. So for example, if you're investing in international stocks and US stocks and they give you dividends, usually you're taxed on that, but not on Canadian dividends and capital gains. Recently, I've also figured out that for the longest time, I thought that US stocks capital gains are taxed, when it looks like they're not. So this is actually a little bit new information for me, so I thought I'd share with you guys. I've always thought that it was all international and all US. For sure, I can clarify that the dividends are taxed because that's happening in my own account, but I don't know about capital gains. So something like the US tech like Apple, Amazon, and stuff like that, I'm going to be testing it out and putting it into the TFSA to see what's going on. So the TFSA, basically, it's tax-free. You're putting in all your contribution room and you're maxed out at that. If you put over the contribution room, you're going to start to get taxed, and you're going to tax very heavily. So make sure that you guys know. They're not going to tell you, they're not going to warn you. You're just gonna have to pay the consequences. So make sure you guys are doing your own accounting. Make sure you guys are keeping track of your money. I do recommend signing up for my CRA because they do tell you your contribution room and your RRSP room. So that's very useful tool, especially the RRSP one, because it is a set percentage of your income. Okay. So another thing is, all the money that you're taking out of a TFSA is not considered income, so you're not taxed on it, but you lose the ability to put it back within the same calendar year. So, for example, if I put in $6,000, it's my first year, right? And then December 30th, I take out $6,000 and I put back another $6,000 December 31st. I don't know why I would do that, but in this, scenario, then I would be taxed an overage of $6,000, because the difference is I put in $6,000, I withdrew $6,000, and now I'm putting in $6,000. So really, under the government's eye, I put in $12,000 this calendar year. Now, if I wait until next year, not only does the contribution room goes up, you also get back the money that you've put in, not the actual money itself, that would be amazing, we'd all be rich, the contribution room. So what does that mean, right? It's a little confusing. So let's say, for example, there's no contribution room next year, okay? It's zero. You're 18 in 2020. You put in 6,000 on December 30th, you take it out December 31st, and then January 1st, you put in that 6,000, okay? Instead of on December 31st, like the last scenario. So what's the difference now? Well, you got your contribution room back January 1st because it's a new calendar year. So you put it back, they gave you your 6,000 back, okay? Now on top of that, the contribution room goes up every year. So if you were to put in 6,000 and then an additional contribution room is given you to 6,000 on January 1st, you can put in another 6,000 as of January 1st, okay? If you did all that, you'd have to wait until next year to put in more money, but you can withdraw it anytime during the year. It's not a good idea to treat it like a savings account. It's not a good idea to treat it like a checking account. It's a good idea to treat a TFSA as an investment account, okay? So when you're going into your branch and they're trying to get you to open a savings account or a mutual fund account, it's much better that you have an investment account where you can make your own decisions. It's self-directed, or where it's a very advanced investment advisor that has more experience and has the opportunity to put in different stocks, bonds, GIC, whatever you guys are investing in. Because if you're just doing that as a savings account, you could just have a savings account. You're not really making much to offset the fact that it's a tax-free account. Same with the mutual funds only one. It might be right for you, but you want to have that flexibility with a self-directed account so that you can invest in whatever you like, or to get advice on investing in different things other than what you're limited to in a savings or a mutual fund account. Okay? So let's go over to an RRSP. So an RRSP is a little different. An RRSP is not tax-free. It's called tax sheltered or tax deferred. So what that actually means is you're putting in your money and it's considered pre-tax, right? Whenever you take it out, it's taken as income, and you also get a withholding tax that you have to pay, and that's anywhere between 10 and 30%, depending on if you took out $0 all the way to 15,000. Okay, everything 50,000 and up is withholding tax of 30%. And then on top of that, it's taxed at your normal income tax. So if it's less than 30%, then you'll get it. It'll adjust during tax time, but you guys are very used to that by now because we have to do those damn taxes every year. The cool thing about an RRSP is that it's recognized by the states as a registered account. So a lot of the US dividends stocks that you're putting in there are not taxed. Okay, so notice that I said some US dividends. So not a lot of people know this, but there are US dividends that are still taxed regardless if you put them in an RRSP or a TFSA. So the biggest example I can give you guys are LPUs, limited partnership units. So if you want to hold that stock, those type of stocks, like US LPU units, it doesn't matter if you put them in an RRSP or a TFSA. It might be better to put them in a TFSA so that you don't have to pay as much withholding tax when you take them out. So how can you actually tell? Easiest way I can tell you guys is to call your broker. But honestly, if you are picking your own stocks and ETFs, a lot of ETFs don't have LPUs though. You're putting, like, for example, I think Brookfield Partnership, those are usually LPUs, so those are taxed, right? And they're taxed by the sometimes the SEC, and there's a filing fee as well. So sometimes it's even worth it, even if it's taxed, right? Because generally the US market has outperformed the Canadian. So that's something to take into consideration as well. But the biggest thing is that the RRSP is a way to shelter your income. So if you guys have ever done your taxes during tax time, if you've put in your RRSP limit, it's deducted from your income. So the cool thing about that is at tax time, sometimes you owe less money, owe no money, and sometimes you even have money that they give you back at your tax return. especially if you're at a lower income. That's very common. Okay, so guys can already start to see kind of the differences and the benefits of RRSP and a TFSA. So before we kind of go into which one should we max first, let's talk about what should we be putting into a TFSA rather than an RRSP. Okay, so in a TFSA we want to put in what we cannot get taxed on the RRSP, right? So the TFSA, we want to put in our Canadian dividend and growth stocks and some blue chips that have no dividend on the US side. I forgot to mention in text, okay? Why? Because in a TFSA, we want to make as much as possible. You don't want to treat it as a gambling account, but for example, if you put a stock in there and it grows to 50%, 100%, right? This is more of the value stocks that we're looking at here, not the kind of the penny stocks. You sometimes can't even put in those into a TFSA. Imagine making 100%, withdrawing the money, and you're using and it's not taxed at all, right? It's going to be so beneficial for you to have that. So you want to have these growth, you want to have that value, and you want to have those big dividends, big juicy dividends, just working away, dripping in there, and then eventually you're going to have a huge stack that you're going to be able to take out and use, for your retirement or for bigger purchases, right? So TFSA you want to look at is as your big purchases before retirement and big gains, okay? Your RRSP, on the other hand, because it's US, you can have US stocks and dividends, and they're usually able to outperform the Canadian market, and you don't need any huge gains in your RRSP. You want to have that slow, methodical income in there, as well as that nice appreciation, because in the long term, usually 20-30 years, stocks tend to go up no matter what happens, if it fluctuates, even if there's like 2 or 3 crashes, right? So you want to have that stability in there, as this is for your retirement, and it's going to be taxed as income anyway, right? So if you make a lot, it's going to be taxed. The difference is that when you turn 71, it turns into a RIF, RRIF. You can do it earlier. It's called a retirement income fund. So you get a percentage of the dollars per year, not with no withholding tax. It is still considered income though, so you will have to pay income tax on it, right? But you don't have to pay the 10 to 30% withholding tax. Okay, so what, Mike, what should we be maxing first? So I have a little kind of diagram here, so you guys can, as I'm talking, you guys can look at it here. But the biggest thing that you guys have to remember is that it really mostly depends on your income and your life situation. So if you are, maximizing your benefits, if you have low income, a lower income like 40,000, a more medium-sized income, however you want to call it, and right, we have the GIS clawbacks as well. So because of that, you usually want to max out your TFSA. So this is why a lot of the advice that's given to you is usually, if you're younger, you want to put in money into your TFSA. And as you start to get older, you start to kind of weed off a bit and put it into your RRSP. Now, I think that's kind of false, right? Because there are many professionals that start out making, a lot. So it's not really that. And also, as you're getting older, and because you guys watch my channel, you guys are probably very financially literate, or getting there, and you guys are starting to save. You guys will eventually reach a point where you don't have to choose between maxing the TFSA and the RRSP. You'll just have, whatever, let's say 10,000 that you can put between January 1st and December 31st, or 15,000 that you can put in and max both. And then usually after that, when you get, into your income potential, you've paid off your debt, you can start saving 40, 50, 60 grand a year, as well as all the dividends you're making. So at that point, it all becomes, how much money can I put into the market in your non-registered as well. Okay, so you obviously want to max your registered first, then you're not registered, which is your margin accounts, your cash account, and your savings and your GICs if you guys want to do like a very safe emergency fund. Okay, so here let's say we have 40,000. It's a clear winner, the TFSA. Obviously you're not going to get much benefit from the RRSP. You're not going to be sheltering enough, and you're not going to get that clawback. It's not going to really help you on the taxes. It's going to be more beneficial for you to have it tax-free and pay your taxes, because there might not be as much, especially if you're a lower income earner and you're in a household where you are also the homeowner. Then you are like part homeowner. Obviously on 40,000, it's going to be difficult to be a sole homeowner. You're going to have those benefits to you as well, so you might even owe no money or not, or even get money back even without the RSP. Okay, so you can actually it's very beneficial because actually what you're doing is your room that you're not putting in your RSP is saved for later, so you can anything since 1991, okay, and going forward, so you can save that over, so that when you do start making the big bucks, you go through your career, you climb the ladder, maybe you improve your education, maybe you start your own business and it goes off, maybe you make a side hustle and you're starting to earn 100, 120, 140, 200, $300,000, then you can use the unused room that you weren't using in your TFSA in your in the RSP, and deploy that capital and bring down your income. Okay, so what is the actual magic numbers? It looks like it's going to be around $81,000 here, but generally, if you consider yourself a lower income earner, TFSA first, and then you consider yourself a higher income earner, especially if you have rental properties or something like that, you do want to do your RSP first. Okay. So that's it for today, guys. I hope you enjoyed. Please like, comment, and subscribe. Do let me know what you'd like to learn about next, and I'll see you guys later.